Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Algonquin power and utility stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Algonquin is a renewable energy and regulated utility company with assets mainly in the US and Canada. The company invests in hydroelectric, wind, and solar power facilities as well as utility businesses, all through its subsidiaries. The company is headquartered in Oakville, Ontario, Canada, and was founded in 1988. It started trading in 1997 and can be found on the New York Stock Exchange, TSX, and Deutsche Börse. The company operates in the regulated and unregulated utility sector. Regulated utilities own and operate all electricity. The utility company owns the infrastructure and transmission lines, then sells it directly to the customers. Also, regulated utilities must charge rates set by the state. Unregulated markets are when non-utility entities own power plants and transmission lines and sell electricity into a wholesale market. Retail suppliers purchase the electricity and sell it to the end user. Transmission companies or utilities own and operate the transmission grid. Another way to describe it is in a regulated market, a company operates a vertically integrated monopoly that covers the entire value chain with oversight from a public regulator. In a deregulated electricity market, market participants other than utility companies own power plants and transmission lines. So utilities are regulated monopolies, meaning they're the only companies legally allowed to deliver electricity or gas to people within a geographic area. Algonquin has 8.8 million miles of gas distribution lines, 14,000 miles of electricity distribution lines, 5,000 miles of water distribution mains, 300,000 electric customers, 370,000 natural gas customers, 400,000 water and wastewater customers, 966 wind turbines, 55 hydroelectric generators, and 900,000 solar panels. The number of customers it has been growing each year, and it surpassed the 1 million customer mark for the first time in 2020. 93% of its customers are in the US, 3% in Canada, and 4% international. The big news for this company is that they're investing $9.4 billion over 5 years, from 2021 through 2025. $3.1 billion will go into renewable energy and $6.3 billion into regulated energy. Renewable energy is a hot new craze that everyone is talking about because we want to make our communities more green and more environmentally friendly. Regulated is a safer investment, and it is more guaranteed. So that is why 2/3 of the $9.4 billion are being invested in regulated energy. Let's get started with the model. This is a mid-cap company, $9.7 billion market cap. They're trading at $16 a share, and they have 612 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they do have positive free cash flow in 2018 and 19, but a big negative in 2020, and even a bigger negative in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that grows a lot from 185 million to 860 million. Revenue is the sales for the company, and that grows nicely from 1.6 billion to 1.8 billion. This is the company's income statement. The top line is the revenue, the sales. So you can see in 2020 they had 1.7 billion of revenue. 1.4 billion was regulated and 270 million was in renewable energy. I would expect renewable energy to grow, but I do see regulated energy growing as well. Maybe not as much as a percentage, but it will be growing because we're going to always need energy. There's so many homes in the US and Canada that need gas and electric. Below revenue is the cost of revenue. These are the expenses directly related to generating the revenue. The big cost of revenue is the cost of electricity and cost of gas. So the prices of those commodities affects their cost of revenue. Revenue minus cost of revenue gives you your gross profit. That was the highest in the trailing 12 months. Then below that is operating expenses. They have big operating expenses, depreciation, since they're always investing in infrastructure. Then below that is operating income. And their operating income is the lowest in the trailing 12 months, mainly because their depreciation expense is getting so high from all their investments. They paid $185 million of interest on their debt, which is the most interest they paid in a 12-month period. So they can cover their interest payments with their operating income, but maybe 1.5 times. I prefer to see operating income at least 2 times interest expense. And even at 2 times, that doesn't give you that much room to breathe, because you never know when something can happen, like the price of commodities goes up drastically, or you have a really bad year, and suddenly you can't afford to pay the interest on your debt. But at least they can cover their interest payments. That's a good thing. And the bottom line of the income statement is their net income, which is really high, $860 million. I would just focus on operating income when I look at the income statement, not net income, because the reason their net income is so high is because of the $721 million of other income and expenses. That's mainly from the fair value adjustment for Atlantica. They own a part of this company, so if the stock price for this company goes up a lot, they have to report that as a gain on their income statement. And if the stock price goes down a lot, they would have to report that as a loss on the income statement. It's called mark to market. So it's a non-cash item. Like in your own portfolio, if you own stocks that go up a lot or go down a lot, it really doesn't mean anything until you sell the stock. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. So you can see they do generate a good amount of operating cash flow, except in the trailing 12 months. And the reason their operating cash flow is low in the trailing 12 months was due to a change in accounts payable and accounts receivables. So it looks like in the first quarter of 2021, they sold a lot on credit. When you sell on credit, it's a cash negative for that period. When you actually receive the money from the customer, it's a cash positive. And it seems like they used accounts payable in prior years. And in the first quarter, they paid back a lot of those accounts payables. So when you buy on credit, when you use accounts payable, your cash flow goes up. But when you actually pay for the items, your cash flow goes down. And as you might have suspected, their CapEx is going up each year. And you should expect their CapEx to be high this year and the next 3 years because of the $9.4 billion project they're doing. Investing in CapEx is a good thing because you're growing a business, which should give you more revenue and more free cash flow in future years. But when you initially spend the money, it makes your free cash flow look really bad. As you can see, they had negative $730 million of free cash flow in the trailing 12 months. But I would expect their free cash flow to improve a lot, especially after they complete the $9.4 billion CapEx project. So in order to fund their operations, they do issue capital stock each year. They issued $500 million in 2018, $360 million in 2019, and $820 million in 2020. Every time a company issues capital stock, that increases the shares outstanding, making your shares less valuable. They also issue more debt than they pay down each year, so they're adding debt each year. They need to add the equity and debt because they pay a dividend payment. So they have to fund their dividend payment and fund their capital expenditures because they're not bringing in enough operating cash flow to pay for those things. This is the equity section of their balance sheet, and they have $5.3 billion of equity. It looks like they raised $5.3 billion from issuing stock. Since this is a Canadian company, they're showing it in capital stock. But for a U.S. company, it would be an additional paid-in capital. And they have negative retained earnings, which is fairly common for utility company, because utility companies use all their profits to invest in infrastructure and to pay a dividend. So they tend to have little or negative retained earnings. But if you looked at a successful tech company like Google or Apple, they would have tens of billion dollars of retained earnings. But not so much a utility company. It's more like buying a bond when you buy a utility company. It's a much safer investment. They pretty much pay a guaranteed dividend payment, but the stock price won't go up 5x or anything like that. It may go up a little bit over time, but it won't 5x or 10x, like a hot new penny stock may. Let's look at the capital structure. $5.3 billion of equity, $6.4 billion of debt. They're 45% equity, 55% debt. And their weighted average cost of capital, which is a blend of the cost of equity and cost of debt, is 6.63%. And utility companies tend to be low-risk investments, so they have a lower WACC than the average company. We estimated 5 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 5, that's $20 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $12 billion. We divide that by 612 million shares. And we get a calculated stock price of $20. They're trading at $16, so they're trading at a 19% discount. It's a buy according to the model. The way I projected their future free cash flows, I added the $9.4 billion of CapEx. That's why they have negative free cash flow in 2021, 22, and 23. They should generate pretty good revenue and free cash flow by 2024. And by 2025, it should stabilize at about $800 million of free cash flow. I project that revenue will be about $8 billion by 2025. Most companies convert 10% of their revenue into free cash flow. Simply Wall Street is even higher than me. They're valuing the stock at $28 a share. 5 analysts priced this stock and the average price target was $16, pretty close to where they're trading at. This is where the stock has been trading at the past 11 years. So like you would expect in a utility stock, it's going up over time, little by little. Similar to a bond, you'll make money over time, not tons of money, but your investment should go up 5-6% a year. This is where the stock has been trading the past year, so it seems like it's up and down. So in a shorter time frame, it may look a little more volatile. But over 10 or 11 years, like the chart we looked at earlier, you can see how their stock price smoothed out and it went up pretty much little by little over time. And the company's board recently approved a 10% increase in their dividend. This is the 11th straight year they increased their dividend by 10%. So that's a nice thing about a company like this, that stable dividend payment. And they pay a pretty good dividend yield, 4.3%. They pay out 49% of their net income. And since their free cash flow is negative, we can't look at the dividend payment over free cash flow. And they're more generous than their industry. They pay a 4.3% dividend. Their industry pays 3.2%. And analysts are forecasting their dividend to grow to 4.5% in the next 3 years. And they have a really low beta, 0.18. The stock has gone up 16% in the past 52 weeks, while the S&P 500 went up 32%. And this is what you can expect. If the S&P goes up a lot, this stock should also go up, just not as much as the S&P. And if the S&P goes down a lot, this stock should go down, just not as much as the S&P. So the price movements are much less severe with this stock. You can see that 52-week range is pretty tight, between $13 and $18. And the stock is trading between its 50-day and 200-day moving average. Over 2 million shares are traded each day on this stock. Almost all the shares outstanding are on float. A little more than half are held by institutions, and 3% of the shares are shorted. Their industry went up 10% in the past year, 30% in the past 3 years, and 50% in the past 5 years, which is lower than the market, which is what you can expect. But this company has actually beat the market the past 3 years and almost tied the market in the past 5 years. That's pretty impressive for a utility stock because you're getting the safety of investing in utility stock with almost the same upside potential as investing in the market. So this would have been a great investment for anybody. Analysts are expecting their earnings to decrease 13%, but their revenue to increase 7%. In the past 5 years, their annual earnings increased 55%. In the past year, it increased 129%. If you invested $10,000 into this company 10 years ago, you'd be at $44,000 today. That's a 16% annual return. That's an amazing return for a company like this. And this is a Canadian-based company, so their biggest holder is BMO at 6.6%, then Royal Bank of Canada at 3.18%, Toronto Dominion owns 1.9%, and Vanguard and TD also own a good amount of their stock. Let's look at their financial ratios. They have really good price multiples, a PE of 11. And remember, PE is market cap over net income. And their net income was a lot higher because they had to mark up their investment in Atlantica. Their price to sales ratio is decent at 5.3. They have a really good price to book of 1.8. And price to book is stock price over book value per share. The way you calculate book value per share, it's equity over shares outstanding. Equity is on the balance sheet. It's assets minus liabilities, and they have $5.3 billion of equity, $4 billion of tangible equity, because they do a lot of acquisitions, and they have $1.3 billion of intangible assets on their balance sheet. Their return on invested capital is a bit low at 2.6%. They can cover their interest payments a little less than 2 times. They have a really good ROE at 16%. But the way you can get a really high ROE is to take on a lot of debt, because ROE is net income over equity. It doesn't include debt. And they have a pretty weak current ratio of 0.6, and their quick ratio is 0.5. This is just the nature of the industry. For some reason, most companies in this industry have pretty weak current ratios. Remember earlier, we were looking at the statement of cash flows, and I said they sold a lot on credit in the first quarter. That's why their cash flow from operations was low. When you sell an item on credit, you have to book a receivable. They have $366 million of receivables. So this is money other companies owe them. So it is an asset, but it's not really worth anything until they get the money. So you don't want to be too lenient with credit terms, because then you tie up a lot of cash and then you don't have money to pay your vendors. So the company is definitely going to need some debt or equity financing over the next 12 months because they had negative $731 million of free cash flow in the trailing 12 months, negative $600 million of working capital, and they pay out over $400 million in dividend payments. So they're short about $1.7 billion. So it's not too hard to get capital these days, especially for utility companies. It's a lot easier for them because they're much less riskier. So more investors and more companies are willing to give them money. The best way to look at ratios is to compare them to companies in the same industry. I've done videos of 5 other companies in the same industry as Algonquin. And if AQN has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they're pretty much better in every single category except current ratio. Most companies in this industry have a pretty weak current ratio, except for TransAlta. And Algonquin pays the highest dividend. So if you're a dividend investor, this is definitely a company you want to look at. So to summarize, I have them trading at a 19% discount. And this company has done really well. It outperformed most utility companies. Plus, they're investing over $9 billion to grow their business. When you invest so much money, there is a risk the investment won't pay off. But 2/3 of the money they're investing are in the regulated utilities industry, which is kind of like a risk-free investment. As long as they can lay down the infrastructure, it's pretty much guaranteed revenue. They don't have to worry about other companies coming in and competing because the government fixes the prices. Although 1/3 of the investment is in renewables, so there is some risk there. But it's not even close to as risky as investing in an EV startup. You never know if that company could ever sell their cars. So if you're looking for a safe dividend, this is definitely a good stock to look at. I rank their free cash flows 1 out of 10, their revenue 7 out of 10, and their ratios 8 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.